what is a fund of funds that we keep hearing about? So all that is a fund comes in as a limited partner into a syndication. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello, welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer, and I want to talk about the fund of funds. This is something that a lot of people seem to be talking about right now. We talk a lot about raising capital and syndications and fund of funds and what's the difference and what's all this new stuff all about. First of all, let me just break some myths. Fund of funds, syndications, they are not new. Okay. They've been around for hundreds of years. People have been buying real estate as a syndication for a very long time. This didn't just happen over the last, decade, this last cycle. I hear people say it all the time. Oh, this last cycle, syndicators popped up. No, not true. Yes, new syndicators certainly did pop up. That's just what happens all the time. But we know more about it now because of social media. We know more about it now because you can actually legally advertise. And that wasn't the case prior to the 2013 Jobs Act. You could not advertise. You couldn't do crowdfunding. You couldn't do a 506C where we can throw Facebook ads out there and we can put it on to, whatever advertising platform we want, and we can get it out there to the masses, right? So you didn't have that as an ability. It was regulated, so you couldn't advertise. And now we have offerings to where we can take accredited and non-accredited investors through advertising, through the right regulations. And so it's just way more public. Social media has made everything way more public. A fund of funds, that's been around for a long time. Didn't really call it a fund of funds, at least not that I know of, but it's been a lot of years where groups have been investing in deals. Okay. Think of a family office is oftentimes a group, and sometimes it's multiple families that are investing in a deal, right? And this happens all the time. It's been happening for at least decades, but hundreds of years. So simply, syndication or a fund is raising money from people. Okay. And we're then using that money to invest in a piece of real estate, in an oil and gas company, in, you name it, ATMs, whatever it might be, a horse, whatever it might be. Right. So we can syndicate by pooling people's money together, and then we could buy something bigger than what we would just on our own. Plain simple terms. Okay. What is a fund of funds that we keep hearing about? So all that is a fund comes in as a limited partner into a syndication. So at Endurance Capital, we purchase multifamily properties, commercial real estate. And let's say we've got a $10 million purchase or $10 million capital raise. And we're going out to our investors. Now, somebody could say, hey, I like this deal. I want to bring my friends and family into this deal. And so they're going to create a fund for that, and they're going to invest in the deal. Or they've already maybe created, and this is the better way, they've already created a fund, and they're investing in multiple deals. So they're investing in my deal, they're investing in other deals, and they analyze these deals and they decide this is the best one to invest in, or best ones to invest in. Okay, so that's the basics. It's still a syndication, still pooling people's money together. And instead of buying the physical real estate, we're now buying shares of the real estate as a limited partner. And that is key. We have to be a limited partner if we're going to do this. Well, I shouldn't say that. You could technically get some general partnership ownership, depending on how you strike the deal, depending on that gets a little complicated because we have to still follow the same rules, right? So you can't get paid to raise money. If you get paid to raise money, you have to be a broker dealer. Okay, so if you're going to get part of the general partnership, why did you get part of the general partnership? Is it because you brought a big chunk of money into the deal? Well, that's compensation for money in the deal, and you can't do that unless you're doing it for all the investors, and that's kind of a different deal. But that's not usually what's done. All right, so just think limited shares, limited partner shares that fund is investing in. Now, typically, what happens is, and this isn't always the case, but typically what happens is if you come in for a larger amount, let's call it $1 million, $2 million, $3 million. If you come in with a larger amount, then the general partnership typically gives you better terms, and you're going to negotiate those terms. You're going to say, hey, look, the normal split is a 70-30 split, and it's a 7% preferred return to your investors. We're going to come in, we're going to bring $2 million into this deal as a group. We're one LLC, and we want an 80-20 split, and maybe we want an 8% preferred return. And the general partner is going to say, yeah, that sounds good, or no, like this is what we're doing. And so you're negotiating on the behalf of your entire group, the whole LLC that's investing together, getting better terms. And that's the advantage of coming and pooling your money together and putting it in a fund, is you can definitely have some bigger leverage. This is very much the case of a lot of private equity firms. Again, that's pooling money is essentially a fund, right? It's fund of funds. It's a fund. You have a fund manager. Fund manager gets paid to choose the right investments for all those investors to get into. The investors don't choose, but they get preference, right? They get better terms. They can have a step-in provision potentially if the operator doesn't perform properly, and they can assign somebody to say, hey, you're taking over because these guys, they stink, right? We're going to take over and we're going to run this property. So we get paid first, whatever it might be. There's all kinds of different things, that the levers you can pull, and the more money you bring, the more levers you can pull. So what we're seeing right now with the fund of funds model is sometimes really good, and people are doing it right. And other times people are doing it wrong. So I want to talk about that. First and foremost, I want to reiterate, you cannot get paid to raise money. So co-GP, fund of funds, it doesn't matter what it is. If you're going to co-GP with somebody else and you're helping with the raise, that is fine, as long as you're not getting paid a commission, you're not getting paid part of the general partnership, not getting paid part of the acquisition fee, just to raise funds. You need to have true responsibilities, and that's where it gets a little hairy, as a lot of people don't have true responsibilities. They're just raising money and they're getting paid, and that's a compliance issue. That's something you want to look out for. It's done all the time. Just know that that's not legal, and you got to decide if that's right for you or not. That's not what I'm going to say. By the way, everything I say here should be reviewed by your attorney. Okay. A lot of the stuff that I've learned is because of through attorneys. I talk to a lot of different attorneys, not just one securities attorney. And I think that's really valuable, by the way, as we're just talking here and you're getting advice from me, and you're going, okay, what is Dex saying? And okay, I understand that. Now I'm going to talk to a securities attorney and see, does he have any valid points, or is he confused? Did he say something that just wasn't quite right? I think that's extremely important. Make sure that you understand I'm not an attorney, so you need to consult with your own attorney. But then I think it's really important to consult with multiple attorneys and get an idea from these multiple attorneys, a consensus. What do they agree on? What do they disagree on? And why do they disagree on certain things? If they disagree on things, we want to say, okay, why do they disagree on these things? And we want to try to get at least the majority of the people we talk to agree. And if we don't, well, I think tread lightly. All right. So couple things to look out for if you're fund of funds. a few things to make sure you're successful doing it. And this is beyond the capital raising. Of course, that's really important. You got to be able to capital raise. You got to be good at talking with investors, at selling the product that you're selling, right? That you're providing. And so I think it's really important for the fund manager. And typically we have somebody that's the fund manager. And I think it's super important for that fund manager to be investing in these deals, to understand them, to underwrite them, all that kind of stuff. As a fund manager, it's okay to get paid, but you have to get paid for bringing true value to the deal. And you cannot get paid by the general partner. So the general partner can't go, hey, yeah, bring in this extra money and we're going to give you part of the acquisition fee. They can't send it to you. They can't give you part of that deal. Whatever sweet deal they give has to be given to the entire fund, right? So if they give that 85-15 split, that's got to go to the fund. Now, you as a fund manager have to create value in order to get paid. You can't just do the fund, bring it to all your buddies and say, hey, by the way, you guys are going to get a 70-30 split and I'm going to take the margin. I'm going to take that, because the split is an 80-20 or 85-15. I'm going to take the margin. You can't just do that without truly providing value. So how do you provide value? You have to provide something unique that they wouldn't otherwise be able to provide. So a couple of ways to provide value. And we want to check as many boxes as we possibly can. And again, talk with your securities attorney. Okay. But one of the big ways to create value is you are looking at many, many deals and you're doing due diligence on these many deals. You fly to the properties that you're saying, hey, I think we're going to invest in this as a fund. We like this deal. You go and you fly there and you do your due diligence with the GP. You check out the property management company that's going to be in charge. You do all the homework like that. You look at the underwriting. You make sure it's good, it's clean. We really like it. Maybe you've done business with that company before as an LP, as another fund, right? So you've done your due diligence on that group and you have a reason to believe that this deal is a solid deal to invest in. And so, keep your airline tickets, log your, just log whatever you've done, right? So that if you do get an audit, you can say, hey, this is the value I provided. So that's a big one. Another one is to make sure that during the operations that things are in compliance, right? That they're following through with the reporting like they said they're going to, and you are handling that reporting to your group, that the K1s are getting out on time, all that kind of stuff. So making sure that things operationally make sense during, and you're actually checking the financials, and when they're paying a distribution, you're understanding how are they paying that distribution. Maybe they're not cash flowing, but they're paying a bigger distribution of what their cash flow. How does that make sense? Why are they doing that? Does that work? So that's another really important thing. And the other thing is you are bringing different opportunities to your group, and you are making sure that, again, that those are good opportunities, but you're just bringing them good and different opportunities to the group. So those are big things. Provide value. I think that's so important. If we don't provide value and get paid, like that doesn't work. The next providing value is the compensation part. And so we already talked about the split, 70-30 split, 7% preferred return. Maybe you can negotiate an 85-15 split with an 8% preferred return. Okay, well, that's really good. And so now you provide value to investors by giving them that split. They're getting a better split. And maybe it's not quite as good as that because you're going to get paid some of that. But if you're just giving them a 70-30 split, 7% preferred return, you're not giving them any value there. So I think it's really important that you provide greater value to your investor base. So maybe it's an 80-20 split with a 7.5% preferred return. And you're getting a little bit of that. Again, be careful how you get paid. Make sure you're consulting with your attorney on that. But that's really important. And by the way, even if you're like, oh, I don't want to do that, I got to get paid. Great. But why are they going to keep on coming back to you? You have to provide good value. So if you're investing, you think about it, if you're investing in Endurance Capital deal and you're just providing what we're providing, why wouldn't your investors just cut you out and go directly to us and hear right from the source? The only reason they're going to stick with you is because you're providing them good amount of value by shopping multiple deals, by doing all the due diligence stuff, by checking our numbers, by making sure we're in compliance, all that kind of stuff. And lastly, providing better returns than what we provide to our investors. So you're checking all the boxes, right? All right. Some other things that I think are really important to understand is that you are technically an advisor and you have to check with the state that you're in to make sure you're in compliance with that state. So everybody's different. Every state is different. Some states are really easy. Some states are difficult. So some states you can only raise from accredited investors. Some states you have to do specific amount of reporting. Some states you have to be licensed, right? So every state is different, and make sure you're in compliance with your state. Again, it's a securities attorney that's really important to talk with, and maybe even a securities attorney, particularly that's well versed in the state you're in. So extremely important. If you're raising over $100 million or have raised over $100 million, then it's really important because now you hit some federal rules, and you have to likely become a broker dealer in order to hit that. The last thing I want to mention is the 506B versus 506C. I hear that all the time. Well, we're a group together, and so we have $5 million of assets, and we're going to take those assets and we're going to invest it into these deals. And that's not really accurate. And so from what I understand is that your $5 million can't be used for the sole purpose of doing these deals, right? So you can't just raise $5 million and say, we've got a $5 million net worth as a group. So now we're accredited as a group. That doesn't cut it. So you have to either have all accredited investors in your group in order to invest in a 506C, or if it's non-accredited investors in your group, then you have to invest in a 506B. You can't invest in a 506C as the fund. So just understand what you're investing in. If it's a 506C, you want to make sure it's all accredited investors, or somehow have that net worth requirement, but probably not going to happen if it's just a fund. Invest in invest in or be in compliance with the sponsor you're investing with. Okay. If they're doing a 506B, it's fine. You can run it simultaneously as a 506B. 506C, if they're doing it, then make sure you have accredited investors. Okay, one more thing to make sure you're in compliance, and this one is a lot of people aren't doing it, and there's advice both ways from securities attorneys, or thoughts both ways, I should say, from securities attorneys. One securities attorneys I really like to follow is Mauricio Rold, and he is a firm believer, and a couple other securities attorneys that I have talked with too are firm believers that if you're doing a fund of funds, it needs to be a fund. And so the best way to stay in compliance and to make sure you're not getting compensated to raise money in the in the SEC's eyes, is that you create a pool of money, $5 million, whatever it might be, $2 million, whatever it might be. You create this fund, and then with that fund, then you select investments to go into that fund. And so you're going to invest in, Endurus Capital deal. You're going to invest in a Jim Jones deal. You're going to invest in Main Street deal. You're going to invest in, call it 2, 3, 4 deals in that fund. Now, what a lot of people are doing is they find a deal, they like the deal, and they say, I'm going to create a fund, and they create a fund for that deal specifically, and they raise for that deal specifically. Um, and they get compensated for that deal, right? And even if they're hitting all the things that we talked about, the argument that I've heard is that's not really in compliance. Now, again, I don't know. I've heard it both. This one's a little trickier for me because I've heard it both ways. But I personally would err on the side of caution and do a fund and then raise on multiple deals. And the other thing is, if you're doing fund of funds, what I've also been told is you should not be raising for the same sponsor time after time after time after time. Now, if you have 3 or 4 or 5 sponsors and you're raising for, you know, putting your fund is investing in them, I don't think it's much of an issue. But if you're only in doing, let's call it 1, maybe even 2, and you're doing a single fund for each one of them, and it's maybe 1 or 2 groups, and that's all you're doing, then that's a red flag, right? And so we got to be careful about this, especially if it's one group. If it's a one group and you're just time after time after time, your fund is going into that same group, the SEC is not going to like that. And so you got to make sure you're raising for multiple groups. It'd be even better, not required, but even better if it's multiple asset classes. So maybe it's multifamily, maybe it's storage, oil and gas. Like that's even better. Again, not a requirement, but the more we can show that we're not just getting paid capital raising, the better you are at being in compliance. So that's the key, right? That's the key to this whole thing. All right. So that's all I got. Call a securities attorney. There's a ton of them out there. There's a lot of really good ones out there that know what they're talking about. And then there's others that I would say maybe don't, or are skirting the rules, or playing in too much of the gray area. So talk to several and get a good understanding of, okay, this is where we can go, and then move forward. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.